What's up, guys? Chris and Kevin here with Lions Capital Mortgage, and the Fed just cut rates. So let's talk about that. What does that mean when the Fed cuts the fund rate?
After one of the most aggressive campaigns to increase the Fed rate, they went through a very aggressive 50 basis points recently cut. And a lot of people think that means that the mortgage rates just dive and they go down. Well, it affects a lot of things, and the mortgage rates are inversely affected to it. So the other piece to it, although there are some pros by finding maybe some borrowing power being lower, you might find some other things be a little bit not as attractive, right? So if you have money in your savings account, that rate that maybe you're earning interest on might go down. So there's a lot of different things that we're going to kind of unpack a little bit today for what it means to everybody.
Yeah, because this is more than just mortgage rates or credit card rates and things of that nature. Powell actually discussed that there is no direct correlation between mortgage rates and the Fed fund rate, right? That they're cutting, whether they increase or decrease. So there's no direct correlation, but what we tend to see is those tend to follow suit. So people that have money in the stock market right now, savings, interest checking savings accounts, credit cards that we talked about, auto loans, those things will be affected by the Fed fund rate, right?
Yeah. And if you like our content, what we're doing, please subscribe or like us. We want to continue providing information that you want to hear in a way that hopefully you can kind of comprehend it and understand, because there's a lot of media out there and a lot of people don't know what that means to them. Right? So we're really trying to be that financial strategist that comes in and talks about what does this mean to you. And again, in the marina of mortgages, rates have gone lower. So if you're looking to tap into equity, if you're looking to do different things, having a conversation is critically important right now to see what that even impacts. Because if you did get a home in the last couple of years, what's great is that you've earned some appreciation on that, which means that home prices have actually gone up for the last several years. And since 1987, they've gone up almost about on average 4.7%. So that's great for consumers to earn that. They can also lower their interest rate right now through a refinance or tap into the equity of their home by taking cash outs or getting HELOCs. I think that's the biggest thing for us to talk about, is just having that plan and understanding a little more about what this means to you. And also not just the mortgage side, where your investments are. Do you want to invest more now in certain stocks? Do you want to not? We're also in an election year, right? That means a lot of different things. If you look historically about where that has been, rates ticked up a little bit and then they're going to start to ease back down in certain areas. So we are on a path with not only one Fed rate cut, we're on a path for multiple rate cuts. And so I think it's good for people to see what that trajectory looks like and how that can impact them in all of their finances in today's world.
So it's important, let's clarify, because what I hear you saying, it's important, we need to work backwards from the comfortability of the payment. Again, you take buying a car, you may not be able to afford a $1,000 car payment, so you're not going to buy that car that's a $1,000 car payment, right? Because what's the average that a home has appreciated in the last 30 years?
Almost 5% on average.
Almost 5%. So you take a large ticket item like a home that appreciates 5%. So let's say on a $500,000 house at 5% a year, it appreciates what?
Yeah,
525,000, right? So right there, you're gaining a ton of equity. That's what you're looking to do, not chasing the interest rate, which may be minimal what it does to your actual payment, right?
So it's just a component. We did another video on what it looks like with the home prices going up and the interest rates even going down. And it's going to be very close to where your payment is today. So
now, let's also say they were waiting to chase the bottom, or that interest rate to lower, if you will, whether a client's refinancing, whether they're buying a home.
So what happens is more sellers want to list their home because they realize more buyers are entering the market and they're really trying to drive that. What that creates then is competition. When there's competition, more people are going to have that home price start to escalate. So that means you're buying the same home, not at the 5% appreciation rate, you're buying it for even higher. And again, the interest rate isn't your only determining factor for your payment.
Right.
So a lot of those things are important to just talk through. What does that mean? Everybody gets excited about a Fed rate cut, and there's a lot of things to be excited about this. A lot of things from being in the mortgage industry as long as we have. There's a lot of things to be excited about, but again, just being prepared.
Yeah, I mean, we've seen all-time lows in rates to all of a sudden skyrocketing up, and now we're seeing some of that positivity come back in our world, right? And absolutely. So it is exciting. Look, it is coming down. right? That is important. It's making it a little bit more affordability. But the message in here is don't wait for that certain rate. You want to be prepared before then, regardless of the rate, and any of those variable factors we can pivot on, right? We got tons of content for you that we're going to bring to you that will educate you so that you're prepared anytime you go into buying a home. Thanks for joining us today.